Good morning, ladies and gentlemen, and welcome to the MATTIOLI Woods PLC investor presentation relating to the final results for the year ended May 2020. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time via the Q&A tab situated on the right-hand corner of the screen. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard. I'd also like to remind you that the presentation is being recorded. Before we begin, we'd like to submit the following poll. I would now like to hand you over to Michael White, Group Managing Director, Ravi Tara, Group Financial Director, and Simon Gibson, Chief Investment Officer. Good morning.
Morning.
Good morning, and thank you, Paul, and thank you all for joining us today. It's probably perhaps the one meeting of this type that we may well have done via a webinar, but certainly me and the team here are very much getting used to interacting with people via this medium. I think starting with the current situation is absolutely appropriate. As we all know, it's totally unprecedented or precedented, and I think we as a business, like very many other businesses around the country, were not off balance, but we very much weren't knocked off purpose. And for the next half hour or so, we're going to talk you through exactly what we mean by this. We'll talk you through the key decisions we made over the last 12 months and how these affected the business and the results, and then, of course, talk you through the business case for MATTIOLI Woods. First and foremost, it is important for us to, and a point of real pride, that we remained fully operational with an uninterrupted service to clients all the way through the pandemic to date. At the point it became appropriate to work from home, and we had some people working from home a little bit earlier than this, but at the point the lockdown started, we closed the doors on Monday night, and we were fully operational the following day from home. And that's part of our ongoing IT program, part of our ongoing operational program that allowed us to facilitate this. And perhaps a second testament to the culture at MATTIOLI Woods, and we'll come a bit more onto this slightly later in the presentation, is that as a business, looking at the outlook in late March, early April, very much staring into the unknown, we took some decisions in conjunction with our staff to forego bonuses for the year and for the key executive team to forego some salary. And as a position, we can perhaps, and Ravi will talk a bit later on, talk about our views now, but the position as a business was to make brave decisions when brave decisions needed to be made. And I think the second decision we made, it goes hand in hand with working with our staff to achieve that, was that we didn't take any government subsidies. As a business, our position was that we are fully operational, we remain fully operational, we're an essential service, so we're able to carry on working for our clients. Therefore, there were other businesses that very much needed that support more than us. And it's right and proper that we step back from that and allow them to take that help as and when they needed it. And I think the last part to mention when looking at our response to COVID-19 was that as a business, we retained our passion and our empathy with our clients. Within a few weeks of the real onset of COVID-19, our advisory team, and we'll come on to our business model a little bit later on as well, but we're an advice-led practice, and our consultancy team had spoken to the entirety of our client base within a matter of weeks. Initially, this was actually just to say, how are you? And then the reciprocated question, now how are we? Such is the relationship we have with our clients and that trusted advisor status that we seek to retain and maintain. What we will talk through today is some of our key highlights, and I'll take the first part of the presentation, picking out some of the key individual points, but also referring back to our business model. And I think the bottom right-hand corner, as you see the slide there, defines our purpose and how we as a business are looking to create and preserve wealth for our clients and help them understand their finances, particularly in the current climate. I'll then pass over to our Group FD, Ravi, who will talk you through some of the key financials for the year and some of the outlooks and dividend position for the next few months and thereafter, before finally passing you over to Simon Gibson, our Chief Investment Officer, who will give you a little bit of overview as to how our investments have progressed, our capacity for growth, both organically and inorganically or via acquisition, and then I'll sum up with a quick note on our investment position. It's very much been a year of two halves over the last 12 months, albeit they weren't equal halves. We had 9 months within the business of strong organic growth, and in the last quarter of the year, which would have been perhaps a key business or a key trading part of the year for us, with a significant new business brought in via the tax year-end planning. But unfortunately, that of course fell back. However, the second half of the year was very much supported by the previous acquisitions that had come on stream, with full trading years from the likes of Broughton's, full trading years from SAS Solutions, and an element from the recently acquired Turris up in Glasgow. Important to note, and again, we'll talk a bit more about this a little bit later on, that as a business, we are primarily fee-based, with a fulcrum within our company of ad valorem fees and time-costed related fees. And at a point in time, perhaps like now, when ad valorem fees can fall back as markets naturally constrict, what we find is as an advice-led business, we interact much more closely with our clients during these periods, and therefore our revenues on that half of the company increase. The action we took in the fourth quarter, primarily around suspending bonuses and the directors' remuneration, has seen, as Ravi will talk to in a moment, our adjusted EBIT for the year significantly ahead of target expectations. Now, some of that, if you look at the right-hand side of slide 4, some of that actually was gained from operational efficiencies. We undertook a restructure in the early part of the year, which saw our client relationships team more closely aligned, which gained us operational efficiencies, but also the platform to develop over the forthcoming 15 years, to 25 years, or even the next 30 years. But in the second part of the higher EBITDA, which will perhaps be an anomaly, an extraordinary event for this year alone, is that of the cost savings. And we can talk about that in a little more detail. Another key highlight for us as a business is the progression of our Amati acquisition. Now, this is a business that we bought 49% of, 4 years ago, Simon, with the option to buy the other 51%, and that company had 100 million of assets under advice. As we look at it now, maybe 120. As we look at it now, it's closer to 600 million. So a fantastic progression. You can see there the revenue that we enjoy from that acquisition, or that blending of the two companies. But what's perhaps the greatest success story from our perspective is that we as a business understood the real progression of Amati was perhaps in its current format. So we didn't exercise our option to buy the extra 51%, but rather kept that team fully engaged, working collaboratively as a team to carry on building the Amati brand and the Amati offering. Then lastly, and again this will be covered a bit more closely by Ravi, we're going to declare a dividend for this 6-month period that will bring us to a flat dividend for the year. And that the dividend we are paying at the year end is perhaps ahead of what was previously disclosed. And I think from our perspective as a business, this speaks to our outlook for the next 12, 24, 36 months. It was very much the unknown when we were looking at matters in March, whereas perhaps now we would classify the position as a little bit of light at the end of the tunnel. We know as a business we can operate fully and effectively in the current climate, and Simon will talk a little bit later on about bringing on new clients, new acquisitions and the opportunity there. But all of these things brought together really makes our position a relatively strong one. Over the course of the last 12 months, our assets under advice and our assets under administration have slightly fallen, broadly stayed level, but slightly fallen. And sometimes we're actually very okay with that. We're pretty happy to see our assets slightly decrease if there's a real good bona fide reason for it. And as you can see in that box, we have paid out 134 million of client benefits. And we've always said in all of our investor presentations, it's really important to us as part of this trusted advisor, as part of this client relationship journey, that our clients enjoy their pension benefits. So seeing money go out the door in that sense is actually, again, a matter of pride. If you look at the second box, though, you'll see that our investment revenues have still increased, despite the fact that our assets have slightly reduced. This is because we've enjoyed the full year's earnings from the business that we took on last year, the couple of £100 million of assets we brought on last year. It's also an element of rationalisation with acquired businesses where they've equalised the fee structure, and we've gained some efficiencies within the system but retained higher levels of revenue. And again, I'll let Ravi talk about our financial position and Simon talk about Hurley's, but we remain very cash positive with strong cash balances, and it's really pleasing to see that our largest acquisition completed to date, namely Hurley Partners, which was completed pretty much over COVID, has integrated already very, very well. And again, within that business itself, the synergies and their approach to client care and putting clients at the heart of what they do, I mean, they're progressing very well in the current environment. For those of you who haven't seen this slide before, perhaps more than any other picture or image in this slide deck, this encapsulates who we are and what we're looking to achieve. So we refer to this slide as the 5 pillars of our business. And the premise that sits behind all of this is our view that we should do everything we can for clients, managing as much of the value chain as we can sensibly operate, but still, where others do it better, outsourcing to them. The 5 pillars, as they're seen there, could possibly be in any order, save one. Advice should always be at the start. And we very much as a business believe that any financial transaction should be led by advice. And some of the issues in recent history is that that's become a bit more challenging and a bit more expensive for clients. But that's still our view, a very, very sensible one. Now, we have within our advisory team 120 consultants who have been liaising very, very closely with their clients over the last 6 months and equally act as our distribution as a business. So many businesses have great ideas, great concepts, but they can't see these ideas through to fruition and commercial reality because they do not have a distribution channel. Now, we have 11,000 clients and 120 consultants that allow us to achieve that. Once you've provided great advice, clearly you need an administration system that achieves the outcome we were working towards. The last thing you want to do is provide advice and the administration lets you down. And there have been a number of advisors, a number of perhaps big firms, big company names, who are unable to even answer the phone in the early period of lockdown. So from our perspective, having our own administration in-house with uninterrupted client service has been a real strength and really garnered empathy and cemented what were already very, very close relationships with our clients. We're also a big believer in having technology in-house where possible. So we have our own proprietary platform, MWeb, on which we manage both our pensions and personal wealth. We also use a number of other platforms which plug into that, but our aim is to have one point of truth that we own and we develop. We're a big believer that if we have our own technology, we can upgrade it and improve it in line with our needs and our clients' needs, rather than being part of a wider system and hoping the overall improvements relate to us. Moving on to investment management, and that very much is Simon's remit. You know, we've been privileged to enjoy very strong investment performance from Simon and his team over the last 6 months. You know, we, like every other business, saw a contraction in investment values as we went into COVID, but we're pleased to say we've regained on most aspects almost all of that ground. And Simon can talk us through that a little bit more later on. As well as being an asset allocator, running our own DPM, we also believe there is scope within a market this diverse and within our own portfolio of clients who are perhaps slightly more sophisticated to create our own bespoke products. You know, the SIP, after all, is effectively a bespoke product. Now, we have our own custodian REIT, a commercial property investment that we built in-house, our own structured product fund, but equally, when there are better investments and better products elsewhere in the market, we're more than happy to use them as well. Ultimately, we believe by managing all areas of the value chain we can increase our margins, but very much by getting a better result for the client. If we can chip away a few basis points at each of these areas, the total expense ratio, the TER for the client, will come down over time. And if we just turn the slide for a second, this perhaps demonstrates our client estate slightly differently. And I think one of the points we always make when we're looking at the 5 pillars and our client assets is that as a business, we could be managing any element of this part of the value chain in isolation, and as a business, we would be valued based upon that particular segment. Whereas in reality, we manage all 5 of these elements, but are perhaps valued as a business on a single valuation point. So from our perspective, particularly if disruptors come into the marketplace and narrow the spectrum of what can be charged. By being in each and every one of these areas, we provide a very robust and resilient investment model for ourselves, for our clients, and for our shareholders. And so the total assets within the business is 9.3 billion. Those under advice and management is 4.5. And you'll see in the grey box in the centre here, the 2.6 billion that is primarily managed by Simon and his team, albeit that includes, I believe, some of the elements of Amati as well. But this, again, is designed to demonstrate the diverse nature of the holdings of MATTIOLI Woods clients, even within our own asset mix. So with that, I'll pass you over to Ravi to talk through the commercials.
Thanks very much, Michael. A pleasure to talk to you all this morning. What I'll do now is I'll talk us through some of the financial results that we've seen for the last year. And if we start with our revenue bridge, I think the key thing to note here is the fact that, as Michael said, we believe we have a very resilient fee model. If we look at our revenues and almost the investment case, there's two features that do stand out. The first of that is the high level of recurring revenues that we enjoy. And for the last year, we stood at 92%, which is actually a slight increase on the year before. But the key factor that differentiates us is the fact that our revenues are primarily fee-based rather than ad valorem, which distinguishes from others. And what that means is we remain resilient based upon our revenue streams and not solely dependent upon market performance, which, as we know, can go up and down. So if we look at the revenue bridge year on year, this chart exemplifies some of the points that Michael just raised around the fact that we have what we believe is a fulcrum around our revenues, whereby it's based upon both advice and ad valorem fees. And throughout the last fiscal year, or the financial year, I should say, what we saw was demand for advice was consistently high throughout. Now, that was for different reasons, and if you take the first half or the first 9 months of the year, there was uncertainty around initially Brexit, and then we had the issue of COVID. All of these things meant that clients were seeking advice from us rather than purely just transactional investment support. So that was pleasing to see. And if we take the first element of that bridge, which is our discretionary portfolio management, we saw in the year just under £200 million worth of inflows into our business. Now that was similar to the year before, but we saw that consistent level of inflow throughout the year. On the flip side, however, we did see a slight decrease in our advisor fees for our bespoke investment options, namely Custodian REIT, the MATTIOLI Woods Structured Product Fund, and our Private Investor Club. Then the other key component of our revenue is clearly our pensions consultancy and administration. Now, on our core portfolio, we did see an increase year on year. However, we saw those portfolios where we have stepped in to administer them or at the behest of the regulator to support those portfolios, we saw the continued reduction in those portfolios as attrition continues throughout the year. And that is what we'd expect. Those are effectively closed books, which will reduce over time. The other point worth pulling out here is the fact that we saw positive revenue, and I'll come on to contribution in a second, but we saw positive revenue from each of our 3 most recent acquisitions. And as Michael said, those were SAS Solutions in Belfast, Broughton's Financial Planning in the West Midlands, and most recently the Tourist Partnership up in Glasgow. And all of those are showing positive signs of revenue and earnings and adding to the value of the group. And then the final element of that is, as we've discussed already, the continued positive performance of our Amati business, albeit that won't be a revenue impact, that is purely an earnings benefit for us. If we move on to the next slide, this is a slide more for kind of the analysts that we work with, but what this does show is that we believe we're a responsibly integrated business, and by going back to the chart that Michael showed you at the start, where we refer to it as our 5 pillars, we believe that if we can cover more of those pillars, or all of the pillars, we can address more points of the value chain, and in time reduce the total expense ratio for our clients. And that is something that we have actually done in the past. Going back to the last financial year, 2019, we gave back in excess of £3 million of fees. And that was directly from our revenue, but we believe it's the right and proper thing to ensure that TERs are reduced for clients over time. And that's what this slide shows here. So if I take the key components here, for our pension consultancy and administration business, our revenue yield on that has been consistent year on year at just over 30 basis points for both years. Likewise, on our investment and asset management, whilst there's a slight increase year on year, the key thing to note is here that we're offering more bespoke options for our clients, and we are seeing more transaction activity come through, which in turn means a slight increase in fees, but the premise is still the same. We are looking to reduce those over time. The slight nuance then is the property management yield, which is a function of mathematics, but whilst it shows an increase year on year, that's a function of the fact that if you think about the end of the year when markets turned, our property portfolio, so circa 20% reduction in values overnight, which reduced the valuation there, so naturally the revenue yield will increase. And so one final point on our pensions piece is we believe that within that there's a couple of key metrics that we look at, and that is caseload and the fees that we're charging. What we are seeing in the pension business is that we're able to service more clients with fewer people, and therefore what that means is we're recording less time per scheme, and in turn less fees go to the client in the end. If I move us on to our earnings bridge, which is often one of the key slides that everyone wants to talk to, this is, for myself, quite an easy slide to talk to, but equally a very pleasing slide as well. As Michael said at the start, we do see this as a one-off step increase, and we expect to return to normal, or as close to as normal profits as we would expect for future years. But if you look at the first bar there, that is based upon reduced staff costs. Now that falls into 2 parts. This is not all related just to COVID. At the end of summer last year into autumn, we restructured all of our client-facing operations. Now that meant that we went into business units that were closer aligned to both our advisory team and also our clients. As part of that efficiency drive that we look to generate, we did see a cost reduction as we restructured that piece. But the other element that clearly contributes a significant part, or more than half of that, is the decision not to pay year-end bonuses for the year just gone. And as Michael said, that was a decision that we didn't take lightly. We took it in the early days of lockdown, so this was at the end of March into early April, and it was a decision we didn't take lightly, but we took it in order to ensure financial stability and ongoing employment for every member of our team, which we have maintained to this day. If I move on, as I said just now in the revenue bridge, we also saw positive earnings contributions from the 3 acquisitions that we made most recently, but also from Amati, which continues to go from strength to strength. As we said earlier, when we first acquired that business, their funds under management were close to 100 million. As we stand today, post year end, they're closer to 600 million. And in the year itself, we saw another 100 million be added on. So that business continues to improve, and we take our earnings share of that business. The other 2 points to note are that in the year, the 9 months to February that we referred to earlier, we did see positive organic growth, of just under 2%, which from our perspective is very positive. We saw new pension schemes come on. We saw investment inflows come in during the year. So there was a positive picture up until the end of February. Now, clearly that turned with the onset of lockdown and COVID, and as has been the case for many businesses, we saw a slight reversal in Q4, which brought that growth level back down. But fundamentally, or underlying, we did see organic growth increase. So based upon the earnings increase from 14 million to just below 19 at 18.9, naturally that EBITDA increase tracks through to earnings per share increase to just under 48 pence at 47.7 pence for the year. If I look at cash conversion, we remain a highly cash generative business with our cash conversion broadly flat year on year. And perversely, if we had paid a bonus in the year just gone and earnings were at a normalised level, that cash conversion would be closer to 100%. So on the basis of high cash conversion, of our recognition of current trading, which after 3 months of the next financial year, I'm pleased to say we are trading in line with our expectations and in line with our budget a quarter into the year. So on the back of that, we're pleased to propose a final dividend of 12.7 pence, which for the full year means that dividends are maintained year on year at 20 pence in both years. Now, at the start, Michael said that is slightly higher than we initially indicated to the market, and that indication was made in the early days of COVID, and we expect it to be slightly lower. But such is a sign of confidence in trading and in the actions that we've taken more recently, is that we do propose that dividend. But in doing so, we recognise as a team that we have a number of key stakeholders that we work with. Not only shareholders who we recognise that dividends are important to them, and over time we expect to maintain or return to our stated policy of growing dividends over time, and we are still key on that. We also recognise that we have another important stakeholder group, and arguably the most important stakeholder group, who is the team that we are part of and that we work with. And given the decision we took not to pay bonuses last year, for the current financial year, we plan on the back of the dividend announcement to reinstate bonuses for the team for the year coming, not retrospective. So it's almost to say as if the final financial year 20 is done, any bonuses that are paid now will be in relation to the results for this year and beyond. And likewise, we also recognise the importance of our relationships with all of our stakeholders and our clients and everyone that we deal with. So with that, I'll hand over to Simon, who's going to talk a little bit more about our relationship with our stakeholders and our management of that.
Thank you very much, Ravi, and good morning, everybody. We talk about being a responsible and sustainable business, and Michael's referred to how many of our 600 or so staff continue to work from home. So it may seem a little odd to talk about our estate in our modern offices with the first bullet point on this slide, but just as important as it was that we were ready and able to move into what is the current normal back in March and April, so it is important that we are ready to go back to whatever the next normal looks like. We have modern offices across the country, and in particular in our large Leicester office. We have continued to work prior to and of course since lockdown and the pandemic on things like our emissions and our business environmental side of things. And indeed over the last 12 months we've taken 30,000 valuations out of the postal system, out of the printers, and delivered them online via client portals. We know that's very positive from an environmental perspective. It also has great security benefits for our clients, and we know it's been very welcomed. We do anticipate that there will be more pressure on the business, but also on us as managers of assets to report more on what is usually known as ESG, on the environmental, social and governance matters for, as I say, Mattioli Woods and indeed the assets that we manage. Some of that will come from a regulatory perspective. Some of it is undoubtedly coming, and I think we've perhaps seen a turning point throughout the pandemic from clients and investors. We've been very proud to continue the Amati condition of having 10% of the profits from that business go to charity. And indeed, during the lockdown period, we have very happily supported our major national charity, Alzheimer's Research UK, and other more community and local based charities where it's been appropriate and possible to do. Many of those organisations suffered a 40-50% fall in income just at the same time as profit-making businesses were also struggling. We're very conscious that sustainability means different things to different people, and we know that from our client perspective, being a sustainable business means two things. It means that we're trying to do those things properly and correctly from an environmental perspective, but it also means that we're here for them. And we know that we provide great peace of mind to our clients as well as the various products and services that we deliver. Within our asset management side, where we're discretionary managers primarily of that 2.6 billion or so of assets that Michael referred to earlier on, we have had very good performance. We were somewhat more cautious going into this year. Nothing, of course, to do with COVID-19, more to do with what we saw as the situation with global asset prices. And we've managed to maintain some of the benefits we picked up there in the relatively strong recovery that we've seen since. We also generally have less assets invested in the UK than some of our peers. Within that, we're not greenwashing Mattioli Woods. We're not in a position where everything is turning ESG. We have been working for a number of years now on improving the coverage of those type of assets within portfolios, but where it's appropriate. And I suppose in the same way that we've looked at the total expense ratios that both of my colleagues have referred to already, it's important that we are getting good value for money, not just the lowest cost. And it's very much the same thing. We've got to look for the performance metrics as well as some of the other benefits that come. And that is increasingly possible, quite different to 30, 40 years ago when these assets were very few and far between. I think most importantly of all has been positive culture across the business, and in particular, we would like to thank our support of staff, but also the support of our staff for the whole business, and of course, of most importance, continuing to deliver great outcomes for clients. I'm very happy to say that culture wasn't born out of COVID-19. It's a culture that existed long before the pandemic, and the engagement we've had with our colleagues across the business has been nothing short of fantastic. And we must thank them, and of course, it is to deliver to our clients that culture has been fostered over a number of years. This next slide, a little wordy, but I think it's very important. It is about the relationship that we have with our clients, and all of these quotes have come to us between March and August of this year. I think when you listen to Michael talking about us being a trusted advisor, and when Ravi is talking about the resilience of the fee model and so on, it's easy to forget that fundamentally the only commodity that we have is other people's money. And I'll go back briefly to the 5 pillars that Michael covered earlier on. We lead as advisor, and during this time we've been consistent, we've been conscientious, we've been confident, and we've delivered those things to our clients, and we were in contact early on and have remained in contact throughout. So that's the advice piece. The administration piece, well, we've always had to deal with everything from births through marriages, retirement, and sadly, increasingly in the last 6 months or so, deaths. And we administer those, as always, professionally and appropriately. When you look at the platform, that's a lot about the security, and our clients have got the comfort about the security of their assets during this time, even when asset prices have perhaps been a little more volatile than usual. From an investment management perspective, I think the key word has been discretion. We've had many clients welcome the fact that we've been in a position to make decisions, rapid decisions. Sometimes the best decision to make quickly is to do nothing at all, and we've been able to assist clients throughout that period, as a result of which we've had great client engagement as well with the assets that we manage over this very difficult period. And finally, as product provider, and in particular in the SIP and SaaS market, you can look and see that when we set the rules, obviously within the regulatory framework, it's much easier for us to be helpful to clients when they're going through tough times, and let's face it, there's been plenty of those. A quick slide now on the organic growth of the business. Comes under the heading of consultancy. We have around 120 consultants across the business at the moment, most of them in the wealth management team, but also across our employee benefits division. Very importantly, the average age of those consultants is heading for 38 and 3/4, if you like. That is important for a couple of reasons. First of all, we clearly have a great deal of capacity from a timescale perspective. It would be different if our average consultants were 64 and all about to retire. But also our average client ages are 60 for men and 58 for women. And that means that, as someone said to me the other day, you probably want a younger doctor than yourself. I think most people are looking for their wealth management advice to come from people who, yes, have the experience, the expertise, the empathy, but nevertheless can see them through those major life events. When you look at the top left-hand side of this slide, you can see that it is loaded to the left-hand side, and the bars are related to the amount of income that is fee income is brought in by those different consultants. So you can see 15 over on the right-hand side. That's 15 consultants who have fee income associated with more than £1 million. Indeed, many of them are north of 1.25, and we've got a few north of 1.5 million. On the left-hand side is where we're bringing in the bright young things. We're perhaps also retraining people, and we're also having people moving into consultancy from other areas of the business. And we're very, very happy that there's no timescale associated to this. If it takes an exceptional person only 18 months to be ready to see their first clients live, that's fantastic. If it takes someone else 3 or 4 years to get to that point, we very much welcome that, as long as all of the behaviours are appropriate during that time, and the key one is endeavour. So we're very comfortable that this supports and, if you like, shows the future organic growth of this business, because you can only imagine how much capacity the people in the left and to the middle here have to move to the right-hand side. I also want to cover acquisitions, and I know we've got at least one question on this, but let's start with our most recent acquisition. It was actually highlighted, we exchanged ahead of the end of the year for which we're reporting, in fact just ahead of the March budget, but we completed this, as Michael said earlier on, during the lockdown period. We're delighted to have our colleagues at Hurley Partners now as part of the business, and this is a significant transaction for the group. We have looked at the business, and I'll cover our typical criteria on the next slide in a moment, but with the same eyes as we do everything, which is start with the culture. And I'm sorry if this is sounding like a broken record, but that cultural fit is essential. We're not a consolidator. We're not in this just for the numbers. We want to make sure that we're dealing with another business that feels that great client outcomes are important and that shares our creating and preserving wealth approach. We know that the business does. Again, as Michael referred to earlier on, we're already seeing very rapid integration of a very strong and successful business. We've brought on board 9 additional consultants. These aren't reflected in the figures. None of the Hurley figures are reflected in what Ravi and Michael have given you so far. We have some synergies. Now, we do not look for cost synergies typically when we're looking at acquisitions. We're looking for deliverable synergies on the positive side, what we can deliver to clients and how we can bring the best of both businesses together, as a result of which we really aren't terribly keen on term acquisitions, but we know that it makes sense to investors. On that basis, we have seen a move of offices already. We're moving towards that. So we had 2 London offices between ourselves and Hurley, and we're going to make that into 1. And we had 2 Manchester offices between ourselves and Hurley Partners, and again, that's going to be rationalised to 1. So there are, on this occasion, also some cost benefits that go alongside the norm. We also have said on the slide here, the bottom bullet point under the compelling rationale is that we expect this to be earnings enhancing in the first full year. In fact, when we look at the numbers since the year end, we think that might actually be during our financial year, which will be less than a full year. So very positive from an investor perspective as well as clients. Now, to help answer the question about our growth, we not only have a fee fulcrum, but we have a growth fulcrum, which is a combination of organic and acquisitive growth. And I'll be very quick on here because you can see this slide for yourselves, but you can see top left-hand corner, a bit like we have advice on the left-hand side of the 5 pillars. Structural and cultural fit is absolutely essential. We are not consolidators, but we think that the market is ripe for very good and sensible merging and acquiring of businesses. We do look at how easy it'll be to integrate. We look at the numbers, of course, in great detail, a huge amount of due diligence. We do believe that we should be able to enhance the client proposition, and in an ideal world also the distribution by the nature of any deal that we do. The market is highly fragmented. There is an aging population. There's also an aging advisor population. So we are seeing the benefits of us bringing in that youthful consultancy team, which nevertheless has a wide span to it. Our youngest consultants in their early 20s and our oldest in their mid to late 60s. When we're looking at acquisitions, we do see new entrants to the market. We do recognise that, and we'll maybe talk about that again a little later. Very quickly, we have made 24 earnings enhancing acquisitions since we listed 15 years ago. We've seen competitors do 15, 16 in a year. So we're certainly not rushing out there and just saying just because we've got some cash available that we've got to go and spend it. It's got to be appropriate. And we're thrilled, and Michael's referred to all of these firms already, Broughton's, SAS Solutions, the Turris Partnership, and now Hurley have all come into the business in recent times. Amati 3.5, 4 years ago. We think there is a very, very strong pipeline of opportunities. We're delighted with the quality of those as well as the quantity. We will continue to apply all of our normal due diligence here, and our strategic rationale incorporates a regional footprint. We think that will be no less important, even though we're perhaps in different trading conditions now. We continue to look to add value, and we think that there's a very positive adjunct here to the organic growth that we believe will continue to be able to deliver. So with that, I will pass on to Michael just to sum up with the investment case.
Thank you, Simon. Thank you, Ravi, and thank you all for being with us today. But just before we move on to questions, a couple of points in summary for me. I believe the real strength of the business as it stands at this very moment in time is that it's very much business as usual. And not only have we been able to run all of our service lines, interact with all our clients, offer pension payments, investment advice, structural repositioning, all levels that our clients expect from us, we've also been able to continue to expand. So not only has Simon just discussed the expansion of the consultancy team and our distribution itself, we've also taken on 12 new people over the lockdown period, or the pandemic period, perhaps better put. We continue to focus on advice, and indeed via our investment in technology, we've been able to operate everyone from home, as I mentioned earlier on, while still providing full advice to all of our clients. But the key, we believe, to the future of the business is doing business tomorrow but with someone you don't know today. And one of the questions that arose during the webinar was, how do we bring on new clients, and how do we bring on perhaps millennials? Well, one of the benefits, as Simon just alluded to there, is that millennials are very much within our consultancy team. And we've a bright young thing called Nathan, who has interacted with professional introducers via LinkedIn, interacted with clients via Zoom or Teams meetings, and digitally onboarded a client without ever actually meeting them face to face. And Simon and I, perhaps as the advisors in the room, would perhaps not have believed that some 6-12 months ago, but it is the modern world. It's one that we're very adapt to now. Then the second part of the sort of our investment case, if you like, is the total respect, as we see it, for all of our stakeholders. Now, we've been in a position now to pay our dividends at the year end because the position is slightly more optimistic now than it looked at the start of the pandemic. But equally, we as a business have got to balance that with our other key stakeholder, being our clients and our staff, as well as our suppliers, who we need to pay on time to protect them. But with our staff, it's right and proper that, given we all chose collectively not to pay bonuses for last year, it's right and proper that we offer bonuses and pay a little bit up front for the next 12 months. And then lastly, within the business model, lowering the overall TERs for clients is absolutely essential. Now, doing that whilst protecting our margin of 70 bits that we mentioned earlier on in the slide deck. Now, our view is to take on more value chain, lowering the overall TERs, create a better outcome for clients, but also maintaining our revenue streams. But importantly, if our revenue streams do significantly increase, if that 70 bits does significantly increase, then it's right and proper that some of that goes back to the clients. And Ravi's mentioned earlier in his slides the 3 million that we've already given back. Now, some of that's sort of a part of a trend, part of our ambition to lower overall clients' costs. So balancing all of these things together is our long-term strategy designed to create the great client outcomes. So Paul, if I can pass back to you perhaps for some questions.
That's great, Michael, Ravi, Simon, thank you very much. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions investors have submitted already, I'd like to remind you that recording this presentation, along with the Q&A and access to all of this information, will be available on your Investor Meet Company platform. Lastly, before I hand back to the Mattiolli Woods team, I'd like to remind you that your feedback is important to the company. Immediately after the presentation is ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Michael, Ravi, Simon, before we perhaps move on to the Q&A that's come in live today, we had a couple of pre-submitted questions by investors ahead of today's meeting. And Simon, perhaps I could address the first one to you. I think you've covered most of this off in the presentation, but just if there's any other points you could add. The first question we had in, you stated consolidation in core markets expected to continue. How do you position yourself here? What is your criteria, and who is your major competition for acquisitions?
Yes, thanks, Paul. I think we covered the criteria, as you say, and I won't go into the metrics on acquisitions, but certainly we quite often say that we don't think, when we're talking to prospective vendors, who quite often are coming to us, by the way, nowadays, we're seen as a good home because of those 24 successfully integrated earnings-enhancing acquisitions that we've done. Being seen as a good home, we do invariably say, whilst we believe in paying an appropriate price and a reasonably full price, we may not always be the highest bidder. We do that because we think it is important to look for the positives. We're not buying in and starting to slash and cut away at costs. That's not our approach. We think that you've got to be responsibly integrating all of the revenues and all the elements that make up the financial part of that. In terms of the environment, certainly it's fair to say that we have competitors in that market. We're not consolidators, as I alluded to earlier on, but there are new people, new kids on the block. There's quite a lot of cash from private equity at the moment, and although they're very few and far between at the moment, we think there'll be disruptors, perhaps from even other professions and industries coming in. We do have a very good quality of pipeline right now. We're talking to various people at different levels of scale in terms of acquisition, and we're very positive about that side of the business.
Fantastic.
Yeah,
Thank you.
absolutely. I think probably as well to add to that, Paul, if I may, I think probably what we'd also say is, at this particular point in time, I think the next 12 months to 5 years is a real window of opportunity for acquisitions. So we've never had such a full pipeline. We've also got now, to take advantage of that, Nathan Imlach, who's our current Chief Financial Officer. He's stepping back from the board, with Ravi taking on a majority of his duties, but Nathan is to solely focus on acquisitions themselves to take advantage of these opportunities. And that doesn't mean that as a business we're going to see a flurry of acquisitions, but equally we are going to take advantage of the ones where the culture is absolutely right, and exactly as Simon just said, where we can not only bring together two great companies, but also, or in terms of acquisition, but also bring them together really well in terms of integration.
That's great. Thank you, Michael, for adding there. The second pre-submitted question we've had in, I think, Ravi, if I can put this one to you. With a great recurring revenue base, what is your long-term margin expectation? And is the investment in tech expected to assist in increasing this as we adapt to the new normal?
Yeah, sure. So thanks for the question. I think previously we've indicated margins or a target of around 20%. And I think more recently, given a number of structural changes, would recommend that would be 20% plus. Now, the structural changes are twofold in terms of what we've seen, and these are accounting changes, just to pre-warn you. But the first one is in relation to IFRS 16 and how lease payments are now treated. Previously, they were a part of our administration costs within the body of the profit and loss account. Under IFRS 16, what that does, as I'm sure many of you are familiar, but it takes the lease cost out of earnings, out of administration costs, and replaces those with an increased depreciation charge and an element of interest as well. So because of that, naturally, our EBITDA margin or adjusted EBITDA margin would be expected to be increased ongoing. And in the previous financial year, we saw that increase by just over a percent point. The other change then is in relation to revenue recognition. Previously, under IAS 18, revenues in relation to insurance that we provide for properties within pension schemes, that was disclosed what you call gross. So we had the revenue of circa £1 million and a corresponding cost of £1 million, and the margin was included in revenue. Now what we see is that just the net margin that we earn is shown in the profit and loss account. So what that means is then both revenue and cost are reduced by that million. No impact on earnings, but the denominator is reduced by that million. So hence we see another increase in margin of around a percent point again. So based upon structural changes, we've not changed anything fundamentally in what we do, purely in the accounting. We come back to my first point around it'd be 20% plus is probably where I'd guide now. And that would be our long-term position as well.
Fantastic.
And then just on the second point, in relation to how I think the question, Paul, was around how tech would impact that margin.
Yeah, absolutely. I think just looking at that, the investment you've put into tech, is that expected to assist in increasing this as we adapt to the new normal? I guess that's looking around sort of office space and how you're working currently.
Yeah, I mean, there's two ways to answer that. I mean, fundamentally, the tech investment that we've done historically, which was to take ourselves out of server rooms and into kind of the metaphorical cloud, that was done under the premise of operational efficiency and longevity rather than purely cost reduction. Now, clearly, there's a benefit of cost that comes with that, but the whole premise around that was ensuring our future. Looking back, it was the right thing because we overnight were able to work at home. So that wasn't purely on a cost basis. Where we are looking at tech was around some of the questions that have come through, reference millennials and how we'd make that more efficient. And again, our rationale for going into that investment for a potential client platform that we've talked about in the past has been around doing things in a more efficient way for the client, giving them a better experience rather than purely from cost. I think it'd be fair to say it's too early to say what the margin impact is going to be, given that those conversations aren't fully progressed. But in time, as we develop those or that journey, we can come back and give guidance. But for now, I think it's fair to say no sizable impact on margin other than the two things I've talked about.
Ravi, thank you very much. Gentlemen, I know I haven't given you a great amount of time. We've had a number of questions come in through the live feed as well, and some of which you've actually covered off. Obviously, you've talked about the millennials, we've talked about some of this, the tech side. I'm also minded of time as well. We've just come up to the hour.
Yeah.
Perhaps I could just ask you to have a quick scan through, and if there are any questions that you can have the time just to address, that would be fantastic, and then we can perhaps redirect investors for feedback.
Yeah, Paul, we'll probably just do a couple for everybody's benefit, but time is short for all of us, I think. The very first one that came in was about the reasons behind the growth of assets under management of the Marty, and then a question about the option. So I can cover that really quickly. As Michael said, assets under management in February 3.5 years ago were around about 120 million. Marty already had a very good track record, but was not getting in the level of assets that we thought they deserved, and also we felt it was a very good gap fill for us. And when we're looking at acquisitions, we quite often look at either overlay or gap fill, and this was something that we brought into the business that we didn't have previously. The growth to since the end of the financial year, the best part of 600 million, is fantastic to see. It is of course driven by performance. I'm delighted to say that MATTIOLI Wood's own contribution from client assets and so on is very modest in that sense. It's not just the case that we've added the best part of 500 million pounds. We absolutely have not. A few tens of millions is all the contribution that we've added in, which is what we think is appropriate in client portfolios. I think what's happened is that we've been able to give the support to the fantastic management there to provide a little bit of backup so they can really go off and do what they're very best at, which is managing client assets in the UK small cap universe. They run a very successful UK Smaller Companies Fund. They also run the Marty VCT, again very successful with best part of 5% dividend, and they run an AIM IHT portfolio, all of which are gathering assets. On the point about the option, I'm sorry if we didn't make that very clear earlier on, but whilst we went in with 49% with the option to buy the 51%, within the first couple of years we had very sensible and very grown-up conversations throughout the integration period with Paul Jordan and his team, and we came to the conclusion that it was appropriate for MATTIOLI Woods to maintain the 49% and the management to own the other 51%. So we sold the option back to a Marty, so we now own 49% and that deal is completed. There was a quick question about acquisitions and scale. I'll literally spend 30 seconds on that, but when we're looking at future acquisitions, it's everything from the likes of Hurley, where we've got 6 million of revenues, possibly a bit north of that with some other businesses that we look at. Go down the scale to those with circa 1 million of revenues, more like Turris Partnership. All of those criteria are absolutely key and critical. And so think back to that criteria slide. In fact, I'll put it back up so you can see it. Those are the key criteria, and if we're meeting those, then we will look at smaller, more nimble deals as well as larger deals. If you look right up at the other end of the scale, what the city like to call transformational deals, we think there are very few of those around, 10 to a dozen probably ever going to be available, and clearly that is not only a different scale but a different conversation piece. We have conversations with people across that range, and I'm pleased to say, as I alluded to earlier on, that increasingly people come to us to start that conversation.
Yeah, absolutely, yeah. And we are totally open to conversations at either end and the full duration of that spectrum. I think the one other question, just very quickly if we can, was do we see the regulatory landscape restricting or increasing our ability to attract new clients? I think just stepping back for a second, I think the regulatory landscape will be ever increasingly more complex. I think it's right and proper that the industry continues to adhere to very, very high standards underpinned by very, very strong compliance. And from our perspective as a business, we've continued that journey over the last 12, 24 months. I think we've bolstered Ravi, our compliance team, by six people over that period. But I think in terms of attracting new clients, actually the increased regulatory landscape is an advantage for a business like ourselves, who deals very much in the complex end of financial services and the holistic wealth management, and it is very adept at that consultancy-led approach. So Paul, I mean, unless there's any other questions you've spotted, Paul?
No, I think you're absolutely right, and I'm just conscious of time as well. So thank you all for addressing those questions that you could. I think you covered most of those in the presentation. But as always, the company has the ability to review all the questions submitted today by investors, and if they have the chance to answer some more of those questions, we can publish that back out to you. So Michael, I don't know if you've just got sort of a 2-second wrap up before we redirect investors to feedback, please.
Well, just to say thank you, and thank you for you all attending. Thank you to Ravi and Simon here with me today. Thank you to you, Paul, as well. And I think the only last thing I would sort of add to that is in terms of our position. If there were a flurry of acquisitions that we were going to look at over the course of the next 12 months, there's always the potential that we may return to market to fund some of them. And so, no, thank you for your continued support, and potentially thank you for your future support.
That's great. Look, thank you, Michael, Ravi, Simon, for updating investors today. Could I ask investors not to close the session? You will be automatically redirected for the opportunity to provide your feedback a couple of seconds after the end of the webinar. If you've accessed the meeting from our website, the feedback page will appear directly in front of you. If you've accessed via the link sent in the email, you'll be asked to log in and just provide your feedback there. So again, on behalf of MATTIOLI Woods PLC, Investor Meet Company, thank you very much for attending today. That concludes today's presentation.